Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have Morad Askar, better known as FuturesTrader71, back to do another webinar. Morad has actually done quite a few webinars on BMT, and if you haven't already watched them, I cannot recommend them highly enough. Just check out the webinar section and you'll find some on all sorts of topics. Today I asked FT to not do a prepared presentation, but to instead do kind of an extended AMA, or Ask Me Anything session. So what we're going to do is pretty much immediately open this up to questions, and we'll let Morad try to answer everybody's questions the best that he can. We'll try to keep it organized if possible. Also at the end of the webinar, FT selected a book that he's going to autograph, and the name of the book is Coaching the Mental Game, Leadership Philosophies and Strategies for Peak Performance in Sports and Everyday Life. The author is H.A. Dorfman, and FT is going to autograph 5 of those, and we will send them out to winners at the end of the webinar. In order to win one of those books, you will need a BMT username, and that is how I will get in touch with you. So if you don't have one, then go create one. Just log on to bigmiketrading.com and click on register and be ready to give that to me at the end. Okay, with that said, I'm now going to turn things over to FT, and we can go ahead and open up the floor and start getting some questions.
There we are. Can you hear me?
Yeah, I can hear you, and I just gave you control, so you should be able to share your screen now.
There we go.
All right, looks good.
Very cool. I'm really glad you fixed your microphone issue. I'm glad you're able to be on. Actually, you're like super loud and clear. I could tell that you're on a really good mic, so happy that worked out.
Yeah, that's part of the problem. This is the first webinar that we've had on BMT in 3 months because I've had some emergencies and family issues and holidays and whatnot. And apparently something happened between then and now, and all of a sudden my microphone just stopped working. None of my USB devices are recognized. So anyway, I'm using 2 computers. FT had the brilliant suggestion, so I'm doing the presentation on my main workstation, and the audio is coming through my Surface Pro. So anyway, glad it worked. All right, so FT, do you want to give us your disclaimer before we start?
Yeah, because I'm a registered broker, I have to read out this disclaimer to you every time I'm on. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. I just want to remind everyone that I can only share my experience and my opinions alone, and that's what they are. So right, wrong, or indifferent, you have to, before using any of my advice, as careful as I am with what I share, make sure you do your own due diligence before you stake your money on the line.
Right. Okay, very good. All right, guys, so go ahead and start typing in your questions, and I'm going to read through what we already have on the screen. Let's see, Rusty says, hey Morad, I know that you've described volume profiling as your method of seeing the context of the market where buyers and sellers have auctioned and agreed on the most popular prices, but the volume profile itself is not a trading strategy. Can you say what trading strategies you use or recommend?
So volume profiling, and I'll show that here. So just to back up a little bit for those who are not familiar with volume profiling is different than market profiling. This is what market profiling looks like. I use dots instead of letters, but I can easily convert these into letters. In fact, if I zoom in, they turn into letters. This is a classic Pete Stadelmeyer market data organization structure that he came up with back in 1983. Pete Stadelmeyer worked for the Chicago Board of Trade and was basically a statistician who devised this, and now Market Profile is a registered trademark for the CME Group. I used Market Profile for a while. Initially, I did not use anything at all. I used no charts. I scalped order flow using just the DOM and time and sales. Did that in equities. NASDAQ stocks, and then I switched over to futures and continued to do that for quite some time until I noticed that I could not achieve the same return on my risk as I had been as HFT and so on started to eat into the method that I was using. So myself and for my prop group, it became imperative that I start to look for other ways to trade the market. Being as I'm a member of the Board of Trade or the CME group, I could always pop downstairs from my office here in Chicago and go down and see what's going on in the pit, and it just became obvious to me that the big money, the Borsalinos and the big bond traders and so on, what they did, what they benefited from is the context of the market structure, essentially, looking at where the market got active the prior day or in the past, where the market kind of rejected prices, where brokers stepped in and or paper stepped in and moved the market away from prices and so on. And so, I gravitated towards market profile because it seemed to organize the information in an auction perspective. And then over time, I started to recognize, having used CQG for several years and having had market profile with volume profiles next to it, and having used XTrader by TT, which gave you a volume profile next to the latter, they're the first to have that, I started to recognize that there's more to it than that. The information that's available is much more than just breaking up the market into 30-minute brackets. And so a volume profile is what you see here in dark blue and gray. The gray portion is what's called the value area. There's a mathematical way to compute the value area, but a volume profile simply shows you how much, precisely how many contracts traded at each price. And if I zoom out and select my chart, this software that I use will tell me exactly how much volume traded at each one of these prices. 28,060 it went off at 2043.50. And that should line up with what your platform shows you. So not having that information organizes the market for me in a way that tells me where the market actually liked prices. This all ties back to webinars I've done for Big Mike Trading in the past that Big Mike was just talking about, where I go through the basics of how I got to the conclusions that I got to, and the fact, day in, day out, I'm repeating the same process. If you don't follow me on Twitter, FuturesTrader71, you might not have seen the Trader Bites that I do every morning at 8 a.m. Central Time, 9 Eastern, where I basically go through what has happened, what is the market trying to do, how good of a job, who's in control, and what's likely to happen today, and what's the main trade idea for the day using the S&P Mini because it's the most popular product. Not my favorite product, the most popular product. So back to Rusty's question. I need to give you some background, but back to the question, if it's not a strategy, then what is it? It's just a way of organizing data. Just like a candlestick is able to show you where the open is, where the high, low, and close are, so that you have a body and the wicks on both ends, like you see with these candlesticks. Volume profile is showing you where the volume actually fired off for the session, or I can take any portion of this profile and look at what happened. Like if I want to see what happened on this run here, all I have to do is select it, and then I get a profile for that particular section. And I can tell you right now that this profile is showing me that this move up is likely to continue overnight because of the way the volume is so heavily stacked at the top of this profile. This is what's called a weak high. So what strategies do I use then if I don't use volume profiling as a strategy? My strategy is very simple and very, very effective in my opinion. My strategy is to simply understand who is in control. I am essentially trading just the same way as someone was trading their wheat 2,000 years ago at an auction market somewhere in Japan or somewhere in Africa, or a cattle auction here in the U.S. or whatever. I'm basically understanding where supply and demand is. I'm assessing who is in control, who's likely to be controlling the auction in the short term, and approaching the market from that perspective. That's a very hard thing for people to wrap their heads around. And I have a lot of followers on Twitter, and I have some very, very active followers who've kind of come along and looked at my webinars from my website and the chats and the consistent weekly AMAs that we have at Stage 5 and so on to understand this. But it's not one of those things where I hand you a sheet and I say when ABC happens, then expect DEF. That's not how I trade. I trade much more like an athlete would be ready for whatever happens in the middle of a football game. You know, just to pull the Super Bowl into this, but or a race car driver who's actually a human being behind a steering wheel, as opposed to something that was programmed, a car that is programmed, that is on the track, and it just follows if then else statements. So it's important in the way I approach the market. It's important to have the key pieces put together in order to actually become consistent at this, and the key pieces include discipline, doing your own research, finding out really what's required. So what is the strategy? That's it. It's just coming in and placing a bet based on the most likely outcome based on who is already in control. And I use statistics. Again, another webinar I did for Big Mike, it was a statistics webinar where we just examined an edge. So my answer is volume profiling organizes the data, but the strategy is built on who is winning the race, who is able to move prices, and are they doing so on volume or not. So the strategy is more of a comprehensive, holistic perspective on the market as opposed to just a kind of an indicator setup.
Right, and I'd like to direct everyone that wants to explore that further to a fantastic webinar that you did. I think the title was something to do with the edge, blah, blah, edge. Anyway, it was creating an edge, something along those lines is the title of the webinar. I'll try to find it. But you went kind of through step by step of how one might formulate their own edge. So yeah. Speaking of statistics, Brandon is asking, so he says, I know FT prefers Renko bars. Does he ever adjust his Renko bars from, let's say, 2 or 3 ticks? It just went off my screen. 2 or 3 ticks to base it on some type of study like an average true range. So I know that you have this Excel spreadsheet where you basically look statistically at the rotation and the market. Do so you kind of have fixed values that you update every now and then, right? As opposed to using an ATR-based approach.
Correct. So you can use an ATR, but then I don't like averages. Averages do not. Averages are beautiful mathematically, but averages do not describe life. And we're trading life. The market is a living, breathing entity. I'll give you an example. One that comes from a cool book called Naked Statistics. An example is 5 guys are at a bar. Let's not make this sexist. 2 guys and 3 girls at a bar, and they're all worth $10,000. Okay, the average net worth is $10,000, right? And in walks Bill Gates and grabs a seat. Now we have 6 people with a net averages of, say, $50 billion and $50,000 divided by 6 gives you some number. That number does not represent what those 5 participants had before Bill Gates came in. It is not a realistic representation of what is actually there. And that's the problem with averages. And so I don't like using averages. The better description may be a median, but what I like to do is to actually take the Renko bar that I use, So my trigger chart uses a 2 Renko or a 4 Renko. Lately, more commonly a 4 Renko, because the 2 Renko is just too noisy. But I trigger off of this chart. I look for specific patterns to trigger trades once I've decided which way my bias is. And then I look at what these rotations are doing. And every once in a while, I'll update the study. For something like the ES, that statistic doesn't change much. It's the rotation, the average rotation, or the ebb and flow of the S&P is in between 2.5 and 3.25 points. So every time the market moves away from that, especially 2 standard deviations away, which is about 7.5 points, then it gets my attention. It tells me that somebody's stepping in and is being aggressive in pushing the market in one direction. So I start to move from being a balance trader or a mean reversion trader to a directional trader. And if, let's say, I switched from a 2-tick Renko to a 15-minute bar chart. I'm starting to realize the wisdom that Mike uses for swing trading, and I'm looking at a 60-minute or a 15-minute or whatever. I would basically run the same study so that I can identify what is normal, and that's important. That's a really important factor here. You've got to figure out what your sandbox is, or what your boundaries are for the time frame you're trading, for the chart that you're trading, and understand it statistically and contextually. Does that answer the question, Mike?
I think so. And just to follow up for the recording later, so the name of the webinar that I was trying to remember, you posted it in the chat. It's FuturesTrader71 on statistical analysis for a broader edge. It was June of 2013. It's a fantastic webinar, so be sure and check that out. Okay, so I want to follow up with something that you said just now. You talked about when someone steps in, it might move it, a couple of standard deviations away. So a lot of people might inherently think that that is a better opportunity to step in for a mean reversion trade. Why do people think that? And I know there's not a simple answer that describes every possibility in the market, but why is it that human nature, I guess, tends to look at those types of opportunities as mean reversion, even though the evidence is staring you in the face that something is not normal, and that it's like you mentioned, that really it's someone moving the market in a particular direction that you don't want to oppose, instead of stepping in for a mean reversion trade?
Oh, yeah, that's a great question. If you look back at the last person that you knew that had to leave trading because they blew up, if you ask them why they blew up, their answer is more likely to be something in terms of it couldn't keep going. It went too far. It went it exceeded any conceivable idea of how far it can go. And mean reversion is great. The market statistically, and this study is kind of old. It's about a year old, 1,400 days. And what I did here for this study is to test how often is the market trending. And I won't get into the definition of trend here, but essentially the market is trending approximately 18 to 21% of the time. So of all days that were tested, about 18 to 21%, depending on the years you pick for the study, are trending. Most of the time the market's imbalanced. That is the market's preferred state. And in fact, our market here, the ES, has been imbalanced for quite some time. So you look at these, think of it from a swing trader's perspective. If I got long on October 31st at 2005, I had a nice run to 2008, 88.75, but I also had a drop to 1963. So I had about 84 points going for me, and I had about 50 points going against me. But overall, even yesterday, I was a break-even because the market crossed 2005 yesterday from below. The market's in balance. It's been in balance for 3 months. Yes, it's dropping really hard and it's coming back up, but the reason we drop we have these big drops and then we immediately take it back up is because overall the market's imbalanced. The market has already priced in, and this is why it's significantly important to understand context. With the market being in balance, you cannot overstay trades. And in this environment, if I was a swing trader, which I'm not, in this environment, I'm looking for mean reversion kind of moves that are excessive. If even on an intraday basis, when I see that a move has taken place that has exceeded 3 standard deviations, meaning 99.2% of the time it would be inside of that rotation value. Let's say this move from 2021 to 2040 happened in one shot. There were no counter rotations. There were some counter rotations here. If it happened in one shot, the probability that this is going to go from 21 to 22 points statistically is very, very low. It doesn't mean that I'll step in front of it, because I've seen people step in at 10 points, 11 points, add at 15, add at 20, quadruple down at 21, and get their lungs torn out. But I'm going to look for a failure pattern, and that's when I step in. The difference between what I do when it comes to mean reversion and what I've seen a lot of people do who struggle is that I wait for the market to tell me. I'm not trying to catch the top here at 20, 40, 50. I'm waiting for the market to show me that, yes, there are others bigger than me stepping in, and that's when I step in. So
right.
Most of the time the market is mean reverting, but there are also wave counts and things like that I can get into. But there are also instances where if you do have a very unusual wave, an unusual move, you have to understand that as the market is buying, as participants are buying, there are those who are selling to them, and those participants who are selling are losing on an uptrend and are likely to cover at the first opportunity. So there's generally an impulsive move and a follow-through move, a continuation or completion move before the market will actually turn. And we saw that this morning. We saw this move on the open, a pullback, and then here it tried to complete, could not, and then it rotated back and through. So, it just depends on context again. What is happening here,
Right, but I think it's also important, correct me if I'm wrong, when you're talking about like a 2.5, 3 point rotation on a zigzag or whatever, and your 3 standard deviations without a rotation, but all it would take to fall back into the norm is one rotation. So you may move 7 points, 8 points, 9 points, and be approaching the 3 standard deviations, but all it takes is one 6-tick move, counter trend. Right. So people, this is where people get in trouble, right? Because they may think, oh, it can't move any further, and then they take the short, and then it comes back, the 6 ticks. Now we're back to normal, and then it continues higher.
and another 8-point move.
Right.
Yeah,
right.
And that's what when I do homework sessions with our traders. One of the key elements, and I think I covered it in that statistics webinar with you, is I said you really have to define the parameters. It's so important to state the parameters of your study. If you're going to do a statistical study, that study is completely worthless until you sit down and you write exactly what the question is you're answering. And that's exactly what you're talking about. So this here, this graph down here is tracking these rotations. So you can see 6 1/4 points. The red line is 2.5 standard deviations, or 1.5 standard deviations. These red lines are 1.5 standard deviations. They're tied into an alert that goes off. When that line gets crossed, and it tells me to pay attention. If I'm looking at the DAX or crude or something else, it tells me, hey, look over here, something's going on. And you have to remember that the market will cross those lines quite a bit. These are setups for me. These are potential setups, I should say. But they can continue. You can see it went 5.5 points, but it pushed all the way down to -10 points. It can keep going, and you have to wait for the context that supports it. And you're exactly right. This resets every time the market has a counter trend of 6 ticks. Every time it moves in the opposite direction, 6 ticks, it goes back to 0, and it measures again. It starts measuring again. If trading was as simple as saying, getting on BMT and saying, yes, do a statistical study, identify 2 or 3 standard deviations from the norm where the market's operating way outside of its norm, and sell whenever that happens, I wouldn't have much money to make in the market because there would be no edge. The edge is putting that statistic, putting that information with the context. That's when you have the strong hand. The weak hand is one that just operates based on an indicator, which I think is the weakest position to trade from.
Right.
The strong hand is understanding, look, it tried very hard to close the gap this morning, right? On the way down, it just could not push hard enough. Look out above. And then now the question is, okay, what areas do I need to trade? Do I need to put a trade on where I have an edge in that it's likely to fill my exit than it is to fill my stop, and then the trade is on, you know?
And we've got a lot more questions, but I feel like I have to just ask, why is it that so many people have such an incredibly hard time with the answer of context? Okay, because I'm sure that you have these experiences too, but for me, running the forum, 50,000 people, they all have certain patterns that repeat within the types of questions that they ask or the types of things that they're searching for or looking for, and it just blows my mind how many people are expecting to be taught how to be profitable traders, and they don't understand how you can't simply copy someone and that you have to develop your own sense, and that context is something that you can't just define with an Excel study. I mean, why is it, do you think, that people have such an incredibly hard time with that part of trading?
So this appears to be a retail online trader problem, and I'm here to tell you experientially, having back traders, having trained traders, that this is a universal problem. Even when I learned, I remember standing behind a trader that was trading the DAX and would pull $22,000 to $28,000 on a couple of days a week, and it just looked so easy. It just looked like you would just sit down, click a click, and it's done. And it just seemed like, okay, I'm going to go back to my desk and do that, and boom, I hit limit out for the day. The issue here is that the issue, to be honest with you, in my opinion, is education. Education, really, our education system prepares us for failure in trading, in that from the time we are in grade school, we're told 2 + 2 = 4. When the reality, the true reality, especially if you're in a field like chemistry or engineering or physics, or you're in the medical field, you know that injecting somebody with 15 cc's of something isn't always going to give you the same result. They might actually might cause them to die. And trading is the same. 2 + 2 in trading is 3.2 sometimes it's 3.8, sometimes it's 4.6, sometimes it could be 5.2. And so knowing that, and this is the real clincher here, the really hard part for traders to become professional and more consistent, in my opinion, is the hard part is understanding that you cannot control that. You can't control, just like a doctor cannot control whether giving someone an EpiPen for an allergic reaction isn't going to kill them. The doctor's decision to shoot you with a hormone to fix a problem is a probabilistic risk, just as it is in trading when you put on a trade. It is almost exactly the same thing, in my opinion. You're basically going, look, 98% of the people who were shot with this, the people who fall under the bell curve, have responded favorably, and it has helped them. But there's always that third standard deviation outlier, right, who actually is allergic to epinephrine or whatever the chemical is, and actually could go into, swell up their heart and they could die. But you still have to take that risk, otherwise the outcome is not going to be there. So My point is, all you can do, and this goes back to every book that was ever written by anybody that knows anything about trading, is all you can do is manage the risk. So your job is to identify, is there a situation here where I can get into a trade and my chances of getting a profit are greater, even if it's by 5%, greater than hitting a stop. If there is a chance of that, what pattern do I need to find, or what's my entry method, and where's my stop going to be, the risk reward, and the stop is going to be to make sure that if this trade does not work, it doesn't end my career.
Yep.
You know, we have people taking a trade and taking a 50% hit on one trade. If you take a 50% hit on one trade, you are done for at least a few weeks before you have the confidence to actually think in a probabilistic way. You're going to be emotional.
Right.
And that's the hard part, is balancing those things.
Right. So I always say that you should trade size on the I don't care level. You don't really care, right? Because if you start to care too much, you start making stupid decisions. And I bet that you're in a position to know that better than anyone, and running the brokerage. I'm sure that you see it. It's got to be heartbreaking sometimes to see these mistakes repeated 1,000 times. But okay, we got a lot of questions. Let's try to knock some out. So Arnie says, hey, when you open a position, are you looking at the DOM, or are you still looking at charts, even when you're scalping and leaving the DOM and focusing on the chart?
Okay, great question. Once I open a position, the position is being opened based on what I see on my chart, because those are the footprints or the track that the market's leaving behind through price and volume. I do not stare at the DOM. I generally look for what I'm going to do. I look for the price that I'd like to do it at. I look at the DOM to figure out how the market's trading. In other words, what's the order flow like? But that's a refinement thing. You know, is it easily lifting the offer, or is it more easily hitting the bid? When it hits the bid and moves down a tick, does it quickly come back up? There's stuff there that I can't talk through, but you kind of learn to see it and notice it over time. Once the position is on, though, I'm looking right back at my chart, at the chart that triggered the trade, and I'm following the story there. The DOM is created. It's kind of like, you know, you have to ask yourself a question. ICE disseminates 20 levels on the bid and on the offer for their products. The CME disseminates, sends out 10 levels on the DOM. But anything above the first bid and the offer is just smoke and mirrors, and you wonder why that's there, why use up all this bandwidth and stuff. And it's the casino effect. It's the illusion that you might be able to glean more information by having more information. And the DOM, staring at the DOM after you put a trade on, creates an emotional reaction. And I have that emotional reaction. I've been trading 15 years now. I still have that emotional reaction, but I don't respond to it, whereas other people may respond to it and close the trade because they see that they're long and the market upticked, and then there was a big offer that came, and it's you know, there's huge size on the offer and the market's having a hard time going through it, and so let's close the trade. And really, in my experience, the market trades towards size. Its job is to match as many buyers and sellers together. And so I don't like to look at the DOM. Once I get my scale out and I have my risk in the bag, I kind of look, and I campaign sometimes, so I'm just strictly watching the DOM. I know what my targets are and so on. But early on, I strongly dissuade you from watching the DOM, because when you keep your eye on the chart, you can stay a lot more objective, in my opinion. That's why a chart looks different once you exit the trade. You take your loss, and then, you know, your mind settles down, and you look at the chart and you're like, God, how did I not see that when it was happening? It's because your eyes are tied up with the DOM and you're emotionally involved, and you're a different person when the trade is on. So avoid that. You know, my DOM is not the center of my screen. My DOM is actually to the far left. My trade analyzer is on the edge of that monitor to the left, closest to my chart, so I keep the trade analyzer to monitor my position, the statistics on my position, but generally I'm just scanning my charts. I'm looking at what these charts are doing, my trigger chart, my 15-minute, and then I'm keeping an eye on this index or underlying market chart to see if anything is turning or any other products are actually leading the move while the trade is on. But that's it. What else do we have? Mike, did we lose you? All right.
Oops, sorry about that. I was talking into a muted microphone. All right.
Okay.
Let's see. Ali says, hey, can you describe the opening swing in more detail? Opening swing high, opening swing low. How do I calculate it? What does it do for me, etc.?
Okay. The opening swing, I get that question often. Restarted my charts, so I don't have it here. So the opening swing is these dashed lines. The opening swing is simply a barometer, so to speak. It's a way of measuring where the initial buyer and seller have stepped into the market. On a day like today, where the market kind of ran off, you have a very wide opening swing. But in general, when the market's balanced or it's an open auction, the opening swing simply is a line in the sand that we put in that describes where the first key buyer or the first key seller stepped into the auction. Today's not a good example of that. There have been days where it's worked out beautifully, but the opening swing, what does it tell me? It tells me several things. It tells me where the market on open orders got initiated on the buy and the sell side, like this opening swing here, 98 to 91 or 98 to 95, and if the market moves away from the opening swing, retests it, fails to take it, and then continues, that I'm going to trade from that side until it comes back and it fails into it. If the market comes back into the opening swing after moving away, once it comes into the opening swing and holds the opening swing, there's a high probability, in the 80 percentile probability, that it's going to test, that it's likely to test the other side. So there's a statistic attached. These yellow lines here are the initial balance. These are time-based lines. The opening swing is not time-based. In other words, you cannot program something based on the number of bars or the amount of time to give you the opening swing. It is as simple as looking at where was the first high of the day and where was the first low of the day. It's subjective, and I wait for the market to confirm it. So here on this day, we have 95 to 98. So that's the initial opening swing. It looks like it tried higher, tried lower, pushed, extended. So this is definitely the opening swing high. But then it moved back and it pushed all the way to the open. So now I dropped the opening swing low from 95 to 91. That becomes the line in the sand for today. So if we go and look at what that looks like for the rest of the day, when the market steps back in, when the market steps back into the opening swing, then I expect it to test the other side like it did here. So it broke through, tested it by a tick, the close, the prior day's close is there as well, and then I expect it to push through. That is a potential setup for me. On some days, the opening swing is the dictator or the conductor, like an orchestra conductor, for the day. It's a price that just the market just defends that area over and over and over, and those days are not very common, but it's just a measuring stick. The opening swing is simply a measuring stick for how deep or how far the first buyer or the first seller stepped into the market.
Right. Okay, we got 20, 25 minutes left for questions. There's about probably 25 questions, so we'll try to get through. Let's see, Mike says, hey, can you comment on the extreme reduction in liquidity on the ES lately in the last few months? The real-time hour liquidity is less than what used to be available just in the overnight session. How are you handling this?
So volatility is increased. The liquidity drop coincides with what we saw in October with the additional volatility. But it's also in line with Rule 575 by the CME. So the CME put out a rule that severely penalizes spoofing and faking and flipping. And it's very clear, and I don't know of a case where it's been enforced yet, but it creates a very, very high penalty for those algos that sit there and stuff the book. We saw the change happen basically overnight. This may be something that's scaring people, that it's so thin and so quick, but when I started trading futures, that's how it was, and I believe that is the best. It creates the best opportunity. We don't make money unless the market moves, and so the additional swings or the wider swings create better opportunity. The downside is you can't continue to use a 4-tick stop in that environment. You're well within the noise, and so you have to extend your risk. And as long as you have an edge and you're extending your targets, the overall outcome is practically the same, except faster. And that's what I want. The additional volatility may be scary to some people, but it's creating more opportunity for profits and losses, but still more opportunity as opposed to a market that's in a 1.5-point range for 3 hours through lunch before it breaks in one direction or another. And once it breaks, if you're on the wrong side, forget about it. There's no way you can recover. Now you can recover because it just continues to gyrate.
Right. Dragon is asking, hey FT, often I do my homework around 6 a.m. and then he finds out one of his hypotheses will play out in the pre-market. He wants to know if the hypothesis plays out in pre-market, your levels are tested or reached. Do you think that they're still valid after the market opens, and how do you deal with that situation?
Dragon, I keep the same hypothesis. The pre-market tests do not mean much to me. The market needs to test if your homework's based on pit session levels, be it traditional support resistance pivots, whatever it is, then the idea is still valid until the market tests it in the pit session. If you're doing homework on 24-hour charts, Globex charts, and the market takes it out in Globex, my approach would be that, hey, it's already accomplished that. What's the next idea? Also, the hypotheses do not take more than a few minutes to correct or reconceive or recreate or whatever. So you can have, like today, my primary hypothesis is for an early test of the overnight high, responsive selling back to 1850 for potential support, and then 4550 is the target upwards, but more likely it would move into 2003, which it did not do. But once the Hypo 1 tested and retested and was unable to push through, Hypo 1 is done. It's just something I throw away, and then I look at what it has done so far and what it's likely to do from here. Given that the low is 21 points, how far can I project the high to be? So it's a continuous process. Coming in with a hypothesis is really important because you have to have a trade idea. You have to have a plan for what you're going to look for and execute once the market opens. But if the market doesn't give you that, it's not the end of it. You can still look at what's left, and that's why I always come in with 3 hypotheses, if not 5, and then see every eventuality, like the market doesn't fill a gap, if it sits sideways, if it breaks higher, if it breaks lower, is it opening out of range, in value, out of value, and eventually you can cross a bunch off because the market's not honoring those, but eventually what happens is one of your hypotheses will actually play out, and then the question now is, okay, my hypothesis here looks like the long side looks like the long for 45.50, so now my job is to figure out exactly where I need to get in, what can I lean on structurally to take the trade and have a chance at it reaching its goal versus a stop. So don't throw away, if your hypothesis is on RTH levels, and if they're hit overnight, it doesn't matter. The market tends to test and retest the levels during day trading hours anyway.
Right. Okay, Gene says, hey, during the trader bites, you often say that the long-term direction is up. How many months or years is, quote, long-term in that context? And would you, if we were approaching a bear market, tell us the long-term direction is now down?
Okay, so for that, I'm looking at an SPX chart, and what you have to do is put yourself in the seat of an institutional trader. The long-term trader, the long-term investor, is who controls the market directionally. It is not traders like me. Even if I trade a 300 lot per click, I'm not generating any movement in this market. It is the investment funds that come in and take 200,000 contracts over a 30-point range that cause the movement. Overall, what I have to see in order for the long-term to change is I have to see failure, just like we almost had back here in October. I have to see failure, and then I have to see an attempt to take out that last high, and then a failure even further. And we have not seen that. We have not seen that. Every time we've had a failure, we have actually, see this looks like it failed to make a higher low, but it made a higher low. There's a higher low, higher high, lower high, higher low. I need to see not only a lower low, but I need to see a lower high and a lower low on the daily. In addition to that, I look at the weekly profiles, and what I want to see is that price action on a weekly chart. I want to see price action for each one of these weekly bars failing with value failing with it. And so it's rare that that happens, and what it does, it really, in the past, like in 2007 it happened, and it took the rest of the market all the way through the end of 2007 and through 2008 to finally react to it. But what you had is a longer term, the market making higher highs and value making lower highs, and the point of control being at the low for a period of time before the market actually gave up. And what that shows is the longer time frame is actually becoming a seller and is very active as prices go down and not so active as prices go up. I hope that answers your question.
TL says, hey, do you pay any attention to the market on close imbalances?
I don't. I think I know a lot of people post it, and a lot of people kind of, it's become the rave now to post that, to say 580 million on the sell side on the close. I'll speak to my time frame. In my time frame, it doesn't mean anything. The market imbalance has come out at 3:40, 3:45 Eastern, 15 minutes before the cash close. I have no idea if that sell imbalance is being hedged. The buy-sell imbalance of 580 million is being hedged with 1,000 lots short in the S&P or what. It doesn't tell me anything. And if you plot that, you can go back and figure out the imbalances and look at what happened the next day or what happened through the close. And I found no correlation whatsoever. In fact, the correlation was like 45%. It was worse than break even. I just don't find that information useful, although many people charge for that and talk about it a lot. It's really not meaningful, in my opinion, to somebody who's trading as small as we are, just online traders.
Right. Here's a question. So, FT, after you started the retail brokerage, or running the retail brokerage, what What I mean, I can only imagine the amount of new revelations or new information that kind of comes to the surface, or patterns, or however you want to describe it. But do you have any like top 2 or 3 takeaways that you've learned as far as people's behaviors or patterns that maybe you could try to get them to not repeat some of the common mistakes, you know, if you talk about them and address them?
So that's part of why I created Stage 5 Trading. It's to take what I did in prop and make it available online globally. That's the ultimate goal. We've only been at it for 2 years, and it's just a lot more work than I anticipated. But I actually, one of the things that's been on my to-do list since November, when November marks the 2 years that Stage 5 has existed, since November, it's on my list to create a 1-hour video, and I started to write the transcript for it. The video is titled "What I Learned as a Broker." And it's a video that outlines exactly the answer to this question, and I was going to stick it on my website for everybody to watch. And it basically goes through the issues that I'm seeing, the immense contrast that I see between the prop world or the institutional trade desk world versus what traders are doing online. What traders are doing online a lot of times is baffling. Not to use one of our guys here who's had a bad day as an example, but we have a guy who trades the M6E. He's fairly consistent. He's become very confident. He talks in a room about it. You can feel the confidence he's having in trading the micro FX product. And today he gave up close to 55% of his account on one trade. He started to build a short, build a short, build a short. And the euro kept going higher, and that's what I see. This idea that there are several things. One, people do not track what they're doing. They're able to tell me Tom Brady's statistics. For those who don't know who Tom Brady is, he's a quarterback for the Super Bowl champions, the New England Patriots. They're able to tell me every interception they have thrown, their statistic. They're able to tell me every practice he's missed. They're able to tell me how many millions he makes every year. They're able to tell me all of these statistics about this high-performance athlete. But they are not tracking any of this for their trading. And why is it that it's so important that you track these things? It's because it tells you what you need to focus your deliberate practice on. So if you are consistently committing the same error, unless you can track how much that error is costing you, for example, for this particular trader today, this error has cost him whatever it is, 300 and something ticks or whatever it is. Or 2,000 ticks. Unless you write that down somewhere and see it, it's not really making an impact, and you're not able to make a change and realize the full impact of it. That's one error. That's one issue. People don't track their performance and don't track their errors. It's so important to track your error because that becomes a goal for you to deliberately improve. It's kind of like a basketball player who keeps missing a jump shot from 6 feet. If you're not tracking that you keep missing those shots, the next time you practice, you're not going to pay enough attention to that particular sequence to improve it. You're just going to keep working on your strengths and letting your weaknesses kill you when it's time to go live. The other issue is people pay too much attention to how much margin there is. Ooh, I can move my account to some place that has $300 margins. My commission, I could save 10 cents on my commissions over here, over there, not recognizing that it's really important not to have too much leverage. Because if you're trading the S&P for a $1,500 account, your tolerance is going to be very, very little to errors, because you're controlling a $100,000 position with $500 or $400. Your chances, the market only has to move a tiny, tiny, tiny fraction of a percentage against you to wipe out your account. It forces people to become emotional. So being undercapitalized is a huge issue, especially in futures, and that's why I pushed for a micro ES product, which I think we're going to end up having to get everybody to sign a petition for. The other issue is just putting themselves through the learning cycle over and over and over. Just imagine learning to you're learning to be a race car driver, and you have a spin out. You get into a nice Formula One car, and you have a spin out that you survive. Most people will get off the track and go to NASCAR and drive a NASCAR until it spins out. Then they leave that, and then they go and drive a dirt truck or go to a cross-country race, a rally race. That's essentially what traders are doing. They're just hopping from one thing to the next. Oh, there's this new software that's order flow based. I'm going to grab that. Hang on, there's somebody who's sponsoring this forum. I'm going to grab the demo there and see what that does to me. That's not how you become professional at anything. You need to decide first what your sandbox or the parameters of your trading are going to be, and you need to stick with it until you fully qualify or disqualify it and move on to the next thing. It's
right.
It's good to update and change your charts every once in a while, but if you find yourself revolutionizing your charts over and over and over, you're putting yourself through that learning curve again and again and again, and you're losing time.
So, I couldn't help but think. So let me ask you a bit of a personal question. So, why do you do it? Because for the last what month? This is February. So for the last 4 months or so, I've been posting all my trades on BMT in a journal, like every single execution, my statements, everything. Okay, because I just wanted to try to raise the bar and make things more transparent and stuff. And it's great, but you know what? I have to sometimes question why I do it, because, and I can only imagine it's got to be the same for you, because how many people that just don't take things very seriously, or that are coming after those $300 commissions, or like in my case, all they want is like, hey, what is this indicator on your chart? And they don't really pay attention to like anything else that you've been saying and pouring all your blood, sweat, and tears into this project. My project is like the journal or BMT. Your project is the brokerage. So let me just ask like a personal question. Why do you do it? Because I feel pretty confident that it's not the money. So, talk to me. Tell me, why you're doing this. Why not just trade independently,
Because, okay, that's a great question, and people always wonder, why am I doing all this? And I appreciate you asking that question, because it puts into context what I'm doing. It's much easier for me to do what I was doing, which is to come into a dark room with my 6 monitors, bang away for 2 hours in the morning and an hour in the afternoon, and be done at 3:15 Chicago time and move on. I did that for a long time. I did it with prop traders and so on. That's not what I want as far as a legacy is concerned. I'm 43 years old, and if I trade that way, then I can only earn by showing up and trading, which to say it modestly, I do very well. For those who follow on Twitter and so forth, have seen over the years that I haven't changed my game at all. It's consistent, and I say the same stuff. I repeat the same stuff, and people see that stuff working with a decent probability. Not 100%, nothing's 100%, but with a decent probability. My quest now, and posting your journal and so forth is a noble cause to do publicly for the forum members, but I can tell you that it's virtually impossible to do it without a cost to your trading, because when you vocalize what you're doing, when you vocalize your trades, you have to answer to so many things that you have already submitted to your subconscious, and those things start to come up and you're bringing them out of your subconscious. Think of it this way. Think if Tiger Woods decides that he's going to blog while he's playing the Masters, and as he comes up to, you know, hole number 7, and it's whatever, 300 yards, and he's selected his club and he's about to swing, and he says, okay, now I'm going to swing to the left, the wind's cutting to the right, and I'm going to keep my elbow this, and then I'm going to twist this, and I'm shifting this much. By the time he gets up there and swings, his swing will be all kinds of messed up because he's moving items that are muscle memory, are subconscious, into the conscious, and the conscious cannot process that much information like the subconscious can. That's what the Chimp Paradox book was about that I recommended for the last time that we were on.
Right.
You know, that's what it talks about. This has been proven. As soon as you commit things to your subconscious, this is the goal of repetition. Like prop traders sit there and scalp all day long as a requirement early on because you want the execution to be very fluid and very subconscious. As soon as you bring that into the conscious and you have people going, but Tiger, why did you change your shoes? Tiger, I saw the club facing down versus up. Tiger, why don't? All of a sudden you're having to answer to these things, and then the next time you swing, you have to make sure that you're doing what you said you'll do, as opposed to responding to the moment and the context at hand, and your performance will suffer. I used to post my trades live on Twitter in 2009 and 10, and once I became registered, I wasn't allowed to do that anymore because of the liability. And I used to post them live, and my P&L, I was still making money, but my profits would struggle because I was busy typing and then trying to get back into the flow of the market, and I was missing information, and it was terrible. Yeah. But the cost of doing the brokerage is pretty high, but the legacy and the long-term return and the plan and strategy that I have in place that's part of the brokerage and everything that we're doing, the trader development program that I'm working on and stuff, is well worth it. It should change. It should change how online traders approach the market. That's my goal.
Right. Yeah. I certainly won't argue with you on the performance part of it and the hit that it takes and everything. So one last question on a personal follow-up. Doing what you do and everything, I'm sure that you've made a few enemies. I mean, for some reason, I seem to have made a lot of enemies. I get death threats and stuff. I mean, do you have to deal with any of that stuff?
I'm not as famous as you are, I guess. No, I don't get any death threats. I've had a couple of Twitter followers who would, for some odd reason, I'm like laying out everything that I'm doing. I'm being very transparent about it, stuff that I used to take 50% on traders on, and I'm laying it out for everybody to look at, and then the first thing people do or did at the beginning is to discredit it. And my response, and that's why I operated under an alias for a long time, because I wanted my work to be judged for what it is as opposed to who I am. Don't be interested in who I am. In fact, you shouldn't believe anything I tell you right now. You should just see for yourself how the market responds to what I'm doing. And that's the goal. And that's been my response is, look, it's like a radio channel. You switch the channel. You don't like what I'm saying, unfollow. You don't like what I'm doing, get out of the forum. Don't come here anymore, Go start your own. More power. I want to see you succeed, so go. Don't waste your time arguing with me. Right. But, I'm sharing my experience, and that's the best I can do.
Sure. Yep. Well, I know there's a lot of us here that appreciate it. So I see a couple of general questions. People are asking, hey, where can I download the templates for your charts?
The templates are available. The templates are available to anybody and everybody that's part of Stage 5. There's a link that we give people that where they can go into a secure Dropbox and pull the templates and have the exact charts that I have, assuming they have a good feed. So we make that available, and the reason we keep it that way is because I'm constantly updating them, and we kind of reserve it for the people who have actually made a commitment to support what I'm doing. But people who have emailed me who wanted one particular chart or whatever, I've never turned anybody down. but it certainly helps me when you become part of Stage 5. And I know we're a sponsor on the forum, so I can probably say this. You know, we'll match whatever commission you're paying. We'll match the services. We have access to pretty much every platform under the sun. So it's not that big a deal for you to make a move to the brokerage. But this, you know, I'm sorry I'm plugging my brokerage as we breach the subject, but that's not my intent to be on here. I'm not here to promote my brokerage, but if it does help push us along when people come and trade with us.
Right. Okay, so speaking of some of the stuff that you're doing every day, you have the daily Trader Bites. I saw a few different people ask where they can watch that or where they can download it or how that works.
Fantastic. Okay, so the Trader Bites are always in the same spot. So the current Trader Bite's always going to be at this URL, stage5trading.com/TraderBite. We'll give you the most recent Trader Bite. I tweet this out in the morning on both StockTwits and Twitter. I tweet it out at about 8:45 Eastern, but it's the same link. If you want to see the existing Trader Bites, they're also on YouTube, and I'll pull that up here on YouTube on my YouTube channel, and that's, you can find those at youtube.com/FuturesTrader71, I believe. So here they are, youtube.com/user/FuturesTrader71, and you can see these. They go as far back as I think a year and a half, 2 years. Most of them have about 800, 700 views, unique views, and you can always join in. They're free. They're not, you know, there's no obligation. I'm just basically sharing my plan for the day, and then following up on the Trader Bite. I tweet out when things change or what I'm doing early on, at least for the first hour of the day publicly, and the rest I do in the S5 chat room.
Right. Okay, so before we move on to the book giveaway, since we're at 1 hour, I know that there are several questions here that people did not get a chance to have their questions answered. So on BMT, if you do a search on the top right for FT71 space AMA, there's a thread that the FT has where you can ask questions, and he periodically checks in and answers those questions. So please feel free to post your questions that did not get answered into that thread, and he will take a look at them. Also, for the books that we're about to give away, please have your BMT username ready. I will contact you as soon as the webinar is over, so please stick around. It'll be within a couple of minutes, and I'll ask for your mailing address and stuff, and that way I can get all that information over to FT. He can sign the books and get the books mailed out to everybody.
How are we running this? I don't remember how we're running this.
Do you have questions or anything to do a quiz, or what do you want to do to give these away? We can just, you know, do something fun, and yeah, that's fine.
Prepare anything.
Whatever sounds good to you, I'll support. We can keep it fast and loose and just quick and casual and all that good stuff. We got 5 books. We just need 5 winners.
That's really putting me on the spot. Yeah, I didn't. You know, it's funny. We talked about this, and I just never actually sat down and thought about how we're gonna do this.
Well, how about the first 5 people that post a question to that thread? Will that work for you?
That's awesome. That's awesome. That works.
Right,
that works for me. And I review this thread twice a week, and I get in there and answer the questions. So make them count. But I'm sorry I didn't think of a way to do this giveaway.
No sweat. So let's see. It's 5:38 p.m. Central. So it looks like post number 361 is the first one. So we got, and here comes the second one. Someone just posted. So we got 3 more questions. Yeah, 3 more, and we'll have our 5 winners. And guys, I'll reach out to you here in a few minutes to get your information. There comes the 3rd one. So it looks like we're going to hit 5 before I even finish talking. All right, so FT, anything else to cover today, or anything else to say?
I think I just want to leave you with a thought. It's really important to stop chasing some sort of a pill type of solution or indicator or person or chat room. to make the turn. This is a profession. This is a professional endeavor. You don't get to make millions of dollars trading by following, by spending a few $100s on someone's indicator or tool. So I really need you to kind of to sit down and figure out, if I'm going to do this, if I fail at doing this, if I reach the worst case scenario, I blow out my account, you need to be able to walk away saying, I have done everything and anything and everything under the sun to make this work. In other words, I have done the necessary research, have selected the necessary tools, have diligently followed my plan. I have pre-planned my trades, I have planned my risk, and I have executed. But my edge caused my failure, and I gave it 150%. That way, you're not always trading out of fear, and once you're ready to move on, you can move on knowing that it just wasn't for you. And trading is not for everyone. I know a broker shouldn't say that, but I'm not really a broker. I want people to do this. This is my passion, trading. But it's really important to recognize this, because I see a lot of people coming in, they put $10,000, $20,000, $30,000, and they just blow it so quickly on just things that are inconceivable to me. And then they go away and they get a job, and so that they can fund again, and then they come back and they repeat it. And then they email me and say, what am I doing wrong? And the fact is they haven't done anything right except the click. And so when you're doing this, when you're considering trading, this is a marriage to something that really requires all of you to be committed, every part of you to be committed. And you just have to know that if you fail at this, that you have done 150%. So you can move on to whatever you're meant to do without looking back at this as a miserable failure. But a business venture that just didn't work out, just like any other entrepreneurial endeavor you might take on for life. If this works, it is the greatest job in the world. When it doesn't and it isn't working, it is the most miserable job you can get. So you have to give it 150%, and that's really what I'm after here. This is what the brokerage is for and what I'm sharing this for. I'm doing it for those people who really want to do this so that they're not getting spun around spending money on all kinds of courses for no real fruit. But it requires people to kind of give it 150%. That's the thought I want to leave you with.
Right. Sorry about the dogs. Okay, so well, thanks, FT, and we already got the 5 questions posted, so I'll go with you guys in 1 minute to give away the books. And since my dogs are barking, now's a good time to wrap it up. So I'll post this on YouTube a little bit later or tomorrow, guys, and I'll see everybody on the forum.
Very cool. Thank you. Take care.
All right. Thanks, guys.